What's up, everyone, and welcome back to the Stocked Up Show. In this video, we're going to be talking about how to invest in a bear market. I feel like a lot of people over the past year have learned that stocks don't only go up. So in this video, we're going to, talk about the important things to know when stocks are actually falling, because unlike most people think, now's the time to buy when everyone else is panicking. So we're going to talk about how to capitalize off of that and some other important things to know. But Hunter, a lot of stocks right now are down 50, 60, 70, 80% or more. There's a lot of fear going on. What are your thoughts on the best way to invest and navigate in a market like we have now?
I like to research the companies that I'm buying, so I'll look at if a company fell a lot, like a good company like Facebook, for example, and they fell a lot on earnings because of their, same or user growth or whatever they had. It was something that wasn't really that big of a deal considering how many users they actually have on all their platforms. So I like to look at why they fell, and then I'll put in their revenue growth and their profit margins and their free cash flow margins, discount it all back. Like, I'll assume it for the future, discount it all back. And if it makes sense to buy it, then I'll do more research into the company and I'll buy it. And then if it keeps falling, I'll look at it again and see if I screwed up. And if I didn't, then I'll buy more. But the important thing is to buy what you have to know what you're buying. Otherwise, you could end up buying trash that just keeps falling. Like, if you had bought Netflix, not this past earnings report, but the earnings report before, just because it fell a lot and it's Netflix, and they were burning cash. They always have been pretty much burning cash. And then they reported earnings again and they got crushed again. Like, just because something gets crushed doesn't mean that it's at a good level to buy for the long term. You still have to do your research on it.
Yeah.
So I like to, yeah.
Yeah, so basically, even though stocks are down, don't just buy any stock, basically. There's a big difference between buying Peloton because it's down versus buying Facebook when it's down, or a company like that. So figure out why the company's falling, and as long as it's not like a giant problem, and as long as their fundamentals line up, it should be an amazing opportunity.
Yeah, a lot of times the market overreacts to news, whether it be to the upside or the downside. So if you have a company that you want to buy and it reports good earnings and it explodes 20% in a day, and you might think, oh, I have to buy now before it just keeps going up, it's going to go up forever. It's probably not going to. It'll probably come back to like a decent level. Like, things don't just go straight up. Walmart went up, just rocketed up for weeks, like a couple of weeks ago, and then it just tanked on earnings. Today it's down to where it was like a few months ago. So you don't want to let your emotions get in the way. So if you have been buying stocks that were at good levels, like you actually did like some discounted cash flow or any type of valuation model that you like to use, and it's falling, you just have to hold it, because if you sell it, and then if you're trying to time the market, you're probably just going to underperform the market. So you just have to let your research, you just have to trust your research, I guess, and not let your emotions get in the way.
So
and
let's say...
I would also... Yeah, no, you
go.
Oh, okay, I was going to say I would also be putting a significant portion of my portfolio into that SPY or SPLG or VOO, like market-based ETFs, and I like to focus on the S&P 500 instead of the NASDAQ right now, just because, or the Dow. So I think the NASDAQ's way more volatile in bear markets. So
yeah, no doubt. So let's say someone's like, all right, I understand that historically speaking, the best time to invest is when everyone else is panicking, which is what we have right now, basically. It doesn't mean it's the bottom, but let's say someone says, all right, I want to start investing, I want to add more to my portfolio or something like that. but what research do I have to do? Like, Hunter, you say to do your research, make sure the stock's actually at a good level, but like, what specific research should I be doing? Is it oversold stocks on finviz.com? Is it, what's the way to go?
Yeah, it's definitely not that. It would be, you would go to somewhere where you can get the financial statements of the company. You're gonna, boy, if you don't know how to do like financial research and you don't know how to read financial statements, you're gonna have to figure it or learn it. You don't have to figure it out. So if you don't, this is what I would do. I'm not saying this is what you should do, but if I was to restart from when I first began, I would buy the SPY or any market-based ETF like SPLG or VOO, like I said, and then learn how to read financial statements, take a small percentage of that money that I'm investing, and start using that to invest in companies that I found with my own research. So I would read financial statements. You're going to look at the balance sheet, the cash flow statement, the income statement. You're going to look at if their revenue's growing, profits increasing, if their margins are staying steady, or if they're decreasing. You're going to have to look into why they're decreasing. Their debt, their free cash flow, which is probably the most important. I like to look at the retained earnings, and I like to look at their shares outstanding, because a lot of growth companies that people love because they're just super popular. Square, actually I don't know if Square did, but I'm sure they increased their shares a lot. But all these very popular companies, they might double their profit, but if they doubled their shares outstanding, you have access to the same amount of profit that you had before. So you got nothing from it. So you have to look at these things. And then you're going to have to, you can go on to Yahoo Finance and look at like their revenue growth, the analysts' projections for revenue growth in the future. You can use that and assign the free cash flow margins, discount it back to today, and you can find what the company is worth today. And that's where you would want to buy under, using a required rate of return of whatever you want, probably around 10%, since that's what the market returns. And if you're gonna take on risk of an individual stock over something like the SPY, you would want to at least get 10%, because the amount of risk that comes with holding an individual stock is a lot greater than holding a basket.
Yeah. Well, that was boring.
Yeah,
Gosh.
it's boring. It is boring.
Yeah. So I guess it's not as easy as just going to FinViz searching about the lowest stocks this month, which stocks fell the most. But yeah, it's a lot of great information. So long story short, you want to buy good companies that have good fundamentals, good growth potential, and that are trading at fair valuations. There are 1,000,001 different ways to forecast the valuation of a company. We like to do it using our stock analysis dashboard. Link down below. It's an amazing tool. Literally, it will save you so many hours and a ton of money if you do your research. All the financial data is there. We have price targets, so you can calculate your price target for any stock. It's awesome. We're not going to talk about it too much on this episode, but it's awesome. Check it out. It's perfect for this market. But overall, the main point, you want to be buying companies during bear markets. Understand that no one knows the bottom. Not even Warren Buffett. No one does. So here's the thing. You might buy a stock that's trading at an awesome valuation. Let's say you buy a stock at, I don't know, $100, just for like an easy example. Let's say it's an awesome valuation. It's at an awesome valuation at 100. That stock might drop to 90, 80, 70 maybe. No one knows the bottom, but just dollar cost average, meaning buy in over time, and then let time do its thing. If it makes you more comfortable to not stare at the market every day during times of extreme volatility, which we have now and which we will have over the next couple months, then don't worry about it. You don't have to watch the market every day. But the main point is set yourself up by buying good companies. They might take some time to pop back up, but it should be great over the long term.
Yeah. And it might be better if you don't watch the market every day. If you're long-term investing, there's really not that big of a reason to watch the market every day unless you're just looking for companies that got beat on some crazy news that might be an opportunity. But chances are, if that happened, you're going to hear about it even if you're not watching the market. Like Facebook, when that tanked, it was everywhere. Like people at the gym were talking about it, and they don't invest. It was so. Yeah. It might be boring, but find a hobby. You can save your time and do something else. You go fishing or take pictures of rocks. It would be better than watching that. Like people think, oh, it's boring to get 10% a year and do nothing. Well, it's a lot more boring working until you're 85 because you didn't invest and now you can't retire. So it might be boring, but it's going to be better in the long run. Like the chances of you doubling your account every year are zero. So
yeah. And guys, I just want to say, like, even though the information we're talking about right now is probably boring as hell, realistically, the financial / investing world, especially on YouTube, is full of a bunch of BSers that are going to try and tell you what stocks are going to triple in the next week or so. Those strategies do not work over the long term. So even though what we might be saying right now is boring, a lot of the investing information is boring. If anyone's telling you that you can double your account every year for the next 10 years, they're lying to you. You know what I mean? Think about it like this. Warren Buffett, Hunter, what does he have? He has, I think, a 20% annualized return or something like that. A 20% annualized return, right? And he just crushes the markets, right? With a 20% return or even a 25% return. And he's one of the best ever. If someone's telling you you're going to get a 100% return, they're lying to you. And a lot of times people get sucked into that because those are the types of videos that are like, oh, double your money this week. And, so just keep that in mind.
Yeah. Well, they're geared towards younger kids, probably right in high school, graduating high school, going into college. It's exciting to want to be a trader or something that's, oh, I'm a trader and I'm going to make 50% a year. You're not, and you're not going to beat, the chances that you're 18, you just got into the market, you just started learning about it, and now you're going to beat every hedge fund returns ever in history, pretty much. It's not going to happen, and you're wasting years of compound returns on your investments that if you just started a Roth IRA or something and bought the S&P 500 every year, you would be way better off. I actually have a retirement calculator pulled up. I'm going to share my screen. Let's hope it works. It's basically, I'm just going to change the age, and then I'm going to change the percent return so you can see how big of a difference starting later. Losing even 5 years, you might think, oh, it's not that big of a deal. It is a big deal. So this is if you started at 18, put $10,000 in, and then added $250 a month. And this is if you did the SPY, which averages 10% annualized returns a year. So you would get almost 4.3 million at retirement. Now, you would likely be adding way more than $250 a month as you get older, so obviously it would be a lot higher. But if you thought you were going to be a trading guru and you lost 5 years, that gets cut by $2 million. So it's so important to start young, and the earlier you start, the better. And if we have a market crash, what an opportunity. Seriously, because you are gonna get higher than 10% most likely over the course of your time because you didn't get in at the top. Now, I'm not saying try to time the market here, but what I do is I'll dollar cost average into the SPY, And if there's a market crash, I'm going to triple or quadruple how much I'm adding during a market crash, just because I'm betting on the U.S. basically, and I'm fine betting that. Now, if you got 8% return instead of 10%, which would be it would be if you bought like a mutual fund pretty much, because they underperform the market most of the time and they charge a fee. That is huge difference. It's just ridiculous. It's less than half. And then if you even made 1% more than the market, so say you had 90% of your account in SPY and then 10% in other picks that you did yourself and they did a little bit better and you got 11% a year, you would get almost 2 million more.
Wow.
So the difference that 1%, like people will think, oh, I only lost to the market by 1% or 2%. If you do that over the course of your life, you are really giving up a ton of money at retirement. And if you're going to be adding more when you're older, which you are, it's going to make a huge difference. Like if you were to add 1,000, that'd be 20 million. And if you got down to 13, that's a $6 million, because it was 13.8, $6 million difference pretty much. It's huge. So if doing something, the sooner that you fix the mistakes that you're making, or like doing something foolish, the better. That's why when you make a mistake and you lose money, you need to learn from it really quick in investing, because the time that you spend investing in the market is so much more important than pretty much anything else.
Yeah, for sure. So yeah, don't let this opportunity pass you guys. Like, what we see in the market right now is a lot of fear, right? And opportunities like these don't happen too often. Like, we see significant stock pullbacks every couple of years or so, but if you miss those opportunities, it costs you so much. Just like Hunter just showed. Like, I was actually really surprised by this. You showed the difference between if you started at 18 or like 23, and that was like a couple $1 million difference. That's only 5 years, Hunter. Like, that is giant. So it's like, you can't let these opportunities pass by, right? And just the main thing is, like, if you buy solid companies at a fair valuation when everyone else is panicking, you will do better than everyone else. You know what I mean? Like, as long as the companies are actually good companies, they're actually good valuations, and of course, when the market recovers, you will do great, right? But you know, it's not as easy as it sounds, because like obviously everyone knows, oh, buy low, sell high, right? Like, that's what everyone's taught. But it's a lot different when you invest into the market and then you buy low, but then the low gets lower, and then you're down 30%, and then it hurts. And you know, you have everyone saying, "Oh, we're headed for the Great Depression," and whatever. This time it's different. The market's never going to recover. So like, it's not easy to hold when stocks are down. You know, it's really not, and that's why a lot of people can't beat the market. You know, but if you look at it objectively, you say, "I need to do this," and then you do it. Good things will happen. Just give it time.
Yep. You just have to stick to your plan. Like, if you deviate from it, that's where errors happen. Like, if you think you're going to time the market, it's most likely not going to happen. And one thing I forgot to show is Warren Buffett's returns. So if that 18 to 65, 10,000 initial, 250 a month for 10%, which is what you would get in the SPY, gives you 4.3 million. If you got Warren Buffett's returns, I think it's like 20.6, you would have 362.6 million. So if you see people telling you that you're going to get 25% a year, Kathy Wood saying she's going to get 45% annualized return, run. Cover your pockets and run. Hold on for dear life, because they're scamming you. They're liars. And you just, like, that is so absurd. It's such a ridiculous sales pitch. And it's for the fee that they get from you investing in their fund. That's what they want. They want the fee. If you go into and look at mutual funds on Google, it's ads. Their ads are the top results, because they want the fees. So be smart about it. getting over 20% annualized returns is absurd.
So,
And
so I do have one point to this, Hunter. So over the long term, like consistently getting like 25% annualized returns is very hard. But let's say there's a scenario where stocks continue to drop more or whatever. Like let's say there's a scenario where there's a lot of fear in the market, valuations are really low. If you buy in then, there's a pretty good chance you will get, let's say 25% annualized returns for the next couple of years, right? But the big problem though is like, when you're analyzing, when you start at 18 and you end at 65, the average annualized return goes down a lot. So the only exception to what you said, in my opinion, is like, if stocks are really low and you buy in then, that will definitely boost your returns, which will end up making a big deal.
Yeah, you'll get insane returns for a few years.
Yeah.
And then things will go... This is where, like, valuations are, and the market doesn't peg them. Like, the market goes above or below. So if you're buying through the lows, and there's going to be points where it's up here, and your returns are going to be way above, like, you're going to be crushing the market probably if you bought good, solid companies at good valuations, and then they'll come down. And if you do it right, you can beat the market for sure. It's like you just have to be disciplined. Like, you have to sit through points where you're not beating the market and stick to your plan. And like, there are years that Buffett doesn't beat the market. Like, he didn't beat it in 2020. He didn't even come close. He is crushing it right now. So it's just, there are years where you're going to look stupid and years where you're going to look like a genius. But if you look at their long-term charts, like, Buffett is killing it and Cathie Wood is underperforming the market.
Yeah. So yeah.
And
I would say
one more thing.
Go. Yeah.
Promising those percent returns in the next 5 years is absolutely stupid, because you have no idea what's going to happen in the next 5 years.
Yeah.
And saying a number that absurdly high is stupid.
Yeah. Yeah. I mean, overall, buying during times of fear is the way to go. Be strong and disciplined to hold your investments, as long as they're good investments, obviously, like we talked about. Don't be holding, like, Nikola or anything like that. But if you're buying good companies, you'll be good. Let time do its thing, and good things will happen, okay? You just have to let time do its thing. But yeah, Hunter, do you have any final points? Because, during times of fear and uncertainty that we have now and that we will continue to have, there's a giant opportunity. I've missed the last opportunity when the COVID crash really happened. I bought Boeing very low and a couple other ones, but besides that, I missed a lot of the opportunity. And, it doesn't mean that we're in the bottom of the market now, but I just don't want people to make the same mistakes that I've made in the past. So, that's why I'm encouraging people to start a long-term portfolio. Even if it's not the bottom, having a long-term portfolio, as you demonstrated, is such an important thing. So, do you have any final thoughts?
Yeah. The market could fall a lot more from here. Yeah. But that's basically the whole point is the whole point of dollar cost averaging is you're going to get it, the average over time. And that's why I like to put way more in when things are horrific. I don't think things are horrific now. This is not that bad. Things could get way worse. Way worse. You have no idea what's going to happen. Anything could happen. Nobody thought that Putin was going to invade Ukraine, and bam, out of nowhere, just overnight one day. So, you're going to have investments that you pick that lose, and you're going to have ones that win, even if Warren Buffett has them. The point is that if you're buying value, you're going to miss opportunities, but you're going to miss a lot more huge losers than you would doing anything else, pretty much. So that's how you win.
There we go. Yeah, so thank you guys so much for watching today's video. Definitely check out that link in the description and the comments down below. Hunter and I co-developed the stock analysis dashboard. I promise you, it is one of the best tools you can possibly need in this market. it shows you the fundamentals. So like, there's a ton of stocks out there that are low, but you don't know which companies are actually worth buying and holding. So like, literally check it out. If you don't like it, you can cancel. We have a sale running. I promise you it's an amazing tool. We both use it every day. It's awesome. Check it out. You can calculate your own price targets. And then last but not least, don't let market downturns, don't let that opportunity pass by, because just by missing a couple of years, that can have a giant influence on your long-term results. So don't let this opportunity pass by. Don't make the same mistakes I made in the past, and I'm sure Hunter too. But thank you guys so much for watching. If you like the show, make sure to subscribe.